Everyone around you will eventually say the same thing. Rent is a waste of money. Buy a house, it is the only way to real security. The standard logic usually boils down to a simple comparison. If your monthly rent is 25,000 rupees and a home loan payment is also 25,000, then buying must be the smarter move. But that comparison omits the most expensive variables in the equation. This chart sets up a 20-year objective test to see which path results in higher net worth. We use an 80 lakh flat, a 16 lakh down payment, and a 20-year timeline as baselines. We must set aside emotion and focus strictly on empirical inputs and outcomes. Relying on tradition for a multi-crore decision creates a massive blind spot regarding how wealth actually accumulates over 2 decades. The buy scenario begins with a mandatory 20%, but in an index fund returning 12%, it compounds to over 1.5 crore rupees in 20 years. Meanwhile, the property requires a 64 lakh rupee loan, which currently carries an interest rate of approximately 8.5%. This chart shows total debt cost. Over 20 years, interest adds 90 lakh rupees. Add sunk costs like stamp duty, taxes, and maintenance, and the final cash drain for an 80 lakh flat exceeds 2 crore rupees. These continuous cash outflows work against you, requiring the property to appreciate significantly just to break even on the total capital spent. While buying provides a physical asset, it does so by diverting capital into interest payments and unrecoverable maintenance fees. The rent scenario has a lower barrier to entry. You keep your initial 16 lakh and your monthly cost starts much lower than a mortgage. This graph tracks renting's primary risk, inflation. A starting rent of 25,000 rupees won't last. With a 6% annual increase, you'll be paying over 80,000 rupees a month for the exact same home by year 20. Renting also lacks the forced savings mechanism that a bank provides. When the bank demands an EMI, you pay. But as a renter, surplus cash often disappears into lifestyle spending rather than building your net worth. The math of renting only works if you take the difference between rent and a hypothetical EMI and invest it every single month without fail. Renting offers a path to higher capital preservation, but it fails if the renter lacks the behavioral discipline to actually invest the surplus. We compared both paths over 20 years, assuming 5% annual property appreciation versus 11% equity market returns. This matrix reveals the final numbers. The property owner gains an asset worth 2.1 crore rupees, but the disciplined renter who invested their surplus ends up with 2.5 crore rupees, exceeding the property value by 40 lakh. These results change if we adjust assumptions. Higher property growth or a drop in interest rates can quickly shift the advantage back toward buying. The rent and invest strategy outpaces homeownership in total wealth whenever investment returns exceed the local property appreciation rate by a significant margin. This flowchart helps determine which strategy fits your life. It starts by looking at your time horizon and mobility. The Career Mobile Optimizer prioritizes the ability to move cities for a 40% salary hike and automates their savings every month. For this group, renting provides the liquidity and flexibility needed to maximize their primary income earning potential. The settled traditionalist intends to stay in one location for 15 years and prefers a mandatory bill to build equity. Buying is the more effective wealth building tool here, acting as a structural savings plan that aligns with their long-term lifestyle. You can also use the price-to-rent ratio for your specific city. If buying a house costs more than 25 times its annual rent, the market is likely overvalued, making renting the safer financial choice. Choosing between these paths requires an honest assessment of your personal behavior and your career trajectory. Breaking away from the cultural pressure to buy is the first step toward finding a strategy that actually works for your bank account. Run the math for your specific city and your specific interest rate. Be honest about whether you will actually invest the difference if you choose to rent. Choosing the specific trade-off between capital liquidity and structural stability ensures your housing choice actually supports the life you want to build.